to make further progress in rolling back overly burdensome regulations that stifle innovation in our economic growth. These efforts go beyond reducing just regulatory red tape. They're about fostering an environment where financial institutions can thrive and contribute to the stability and growth of our economy. I'd be remiss if I didn't remind everyone in the room today of the doom and gloom economic predictions that we heard across the aisle as the Trump administration was sworn in. In late 2024, Moody's Analytics anticipated that a Republican-controlled government would bring 3.5% inflation, 5% unemployment, a recession, and a budget deficit of 6% of GDP. Since then, Democrats have repeatedly and wrongfully accused Republicans of, quote, tanking the economy, close quote. With most of the official data in the books, these warnings missed the mark by a mile. Inflation came in at nearly 1 percentage point lower than that forecast. The unemployment rate never increased beyond 4.5%. No recession materialized, and GDP is on track to have 3 consecutive quarters above 3% growth. Meanwhile, the budget deficit is on track to fall to some 5.4% of the GDP. These numbers speak for themselves. Under President Trump's leadership and Treasury Secretary Bessent's steady hand, the economy is back on track, reversing the damage of the previous administration. Throughout the 119th Congress and committee Republicans remain steadfast in our goal of reinvigorating the commercial banking system and make life more affordable for our American families. That commitment is why I introduced the Main Street Capital Access Act with Subcommittee of Financial Institutions Chair Andy Barr last month. Our community banking package is designed to revitalize local bank formation, right-sized regulations that are intended for far larger and more complex institutions, ensure that community lenders can focus on serving our families, small businesses, and our local economies. This bill also aligns with the administration's efforts to right-size regulation and reflects the committee Republicans' dedication to ensuring that financial operations focus on safety and soundness with a tailored approach to supervisory complexity. Similarly, our bipartisan Housing for the 21st Century Act addresses housing affordability head-on by reducing the burdens that have made homes and apartment construction untenable. Improving affordability requires directly expanding the housing supply. Paired with Main Street Capital Access, Americans will benefit from more homes and more affordable ways to finance them. We're grateful for your time today, Mr. Secretary. We look forward to the discussion, and I yield back the balance of my time. I now recognize the ranking member of the committee, Mrs. Waters of California, for a 4-minute opening statement.
Thank you very much, Mr. Chairman. Last week, Donald Trump marked his first year in office with consumer confidence plummeting to a 12-year low. That is not a coincidence. Trump promised a so-called golden age, but apparently he only meant one for his family and billionaire friends. Instead of helping families, Trump's trade wars are driving up the price of goods like groceries, clothing, and furniture. Small businesses and farmers feel it too, and we all know exactly who is to blame. Instead of lowering costs, Donald Trump has doubled down on chaos and cruelty while handing more power and more freedom to Wall Street. For example, instead of directing the Financial Stability Oversight Council to address threats to our economy, Mr. Secretary, it appears that using it to do the exact opposite and deregulate Wall Street. While Trump claims he wants to cap credit card interest rates, his administration has repealed rules that curbed excessive credit card late fees and shuttered the Consumer Financial Protection Bureau, the very agency that returned $21 billion to Americans after they were ripped off. In fact, Trump's team has dismissed enforcement actions against predatory firms, even after they admitted to defrauding consumers. Why? Could it be because they gave to Trump's campaign or brought his crypto coins? Or could it be this president is not on the side of the American consumer and never has been? It does not stop there. Right now, Trump's Justice Department is conducting a baseless criminal investigation into Jerome Powell to bully of the Federal Reserve, so they serve Trump's agenda instead of the American people. Since Trump returned to office, Republicans have looked the other way, while consumer protections were gutted. Instead of offering solutions to help families, they have protected corporate profits. Under this administration, billionaires are winning and hardworking Americans are losing. We've seen this movie before. The same blind loyalty and deregulation led directly to the 2008 financial crisis, when millions of Americans lost their jobs, their homes, and their savings, all while Wall Street walked away with bonuses. Despite repeated demands from Democrats for accountability, Republicans have refused to bring other key administration officials before Congress. That includes CFPB Acting Director Russell Vought, who must be held accountable for dismantling the CFPB. This includes FHA Director and Bill Pulte, who has unlawfully installed himself and his staff on the board of Fannie and Freddie, weaponized mortgage data to try to attack Trump's political enemies, and who is incompetently pushing just plain dumb housing policies like a 50-year mortgage. Every turn, committee, Democrats, and I are standing up for America's consumers, defending strong safeguards, fighting corporate abuse, and the corruption of the Trump family. It's just common sense. Our economy should work for everyone, not just for Trump, that billionaire circles that he's involved with. Republicans need to stand up to Trump, defend our regulators, protect consumers, and put families ahead of Wall Street. Anything less is complicity.
The gentlewoman's time has expired.
I yield back.
I recognize the chair of our subcommittee on financial institutions, Mr. Barr of Kentucky, for a 1-minute opening statement.
Thank you, Mr. Chairman. Secretary Bessent, welcome back to the committee. Under your leadership, FSOC has done a terrific job eliminating unnecessary regulatory burdens and promote economic growth. Common sense legislation like the Main Street Capital Access Act is exactly the type of pro-growth proposal to promote financial stability that FSOC highlighted in its annual report. I'm proud to sponsor the TIER Act and the Community Bank Regulatory Tailoring Act that will modernize outdated statutory thresholds that impose disproportionate regulatory burdens on our financial system. This committee, along with FSOC, can successfully support our community lenders and allow them to thrive under right-sized regulation with this legislation in place. Regulatory tailoring helps to protect the diversity of our financial system, which is itself key to promoting financial stability. I look forward to working with the Treasury Department as you implement my outbound investment legislation that the President signed into law in December. With you at the reins, FSOC has returned to its core values and away from the weaponization and disarray we experienced under the Biden administration. I yield back.
Gentleman yields back. I recognize the ranking member of our Subcommittee of Financial Institutions, Dr. Bill Foster of Illinois, for a 1-minute opening statement.
Thank you, Chair Hill. Mark Twain is credited with observing that history does not repeat but often rhymes, and those of us who served on this committee during the financial crisis recognize this poem and its tragic ending. We have once again a historically unpopular president, fixated on the glory of his overseas misadventures and foreign bailouts. We have once again a multi-trillion-dollar asset bubble underpinned by opaque and conflicted financial mechanisms that nobody understands by design, being willfully ignored by partisan financial deregulators. And we have families all over America who, despite all the happy talk from the president, are having a hard time paying their mortgages and their monthly bills. You can hardly open any financial news source without seeing a discussion of the pending collapse of the AI circular investment bubble. And that is why we created the FSOC. And that is why last November, Democrats on this committee sent you a letter as chair of FSOC to figure out what we'll have to do when the music stops. Your response was insufficient, dismissive, and dangerous to our economy. I look forward to hearing more from our questions and yield back.
Gentleman yields back. Today we welcome the testimony of the Honorable Scott Bessent, Secretary of the Department of Treasury and Chair of the Financial Stability Oversight Council. Secretary Bessent, we thank you for taking time to join us today. We'll be recognized for 5 minutes to give an oral presentation of your written testimony, and without objection, your written statement will be made part of the record. Mr. Secretary, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Waters, and members of the committee, Thank you for inviting me to discuss the Financial Stability Oversight Council's 2025 annual report. This report is a culmination of extensive collaboration amongst FSOC members. I'd like to thank them for their hard work and dedication in advancing the President's bold vision for a better America. Since day one, President Trump has focused on building parallel prosperity, an era of economic expansion where Wall Street and Main Street can grow together. To that end, Treasury has tirelessly pursued pro-growth policies to unlock the potential available to all Americans when they are free to save, invest, build businesses, and drive their own economic destinies. The Financial Stability Oversight Council plays an important role in delivering on this agenda. Too often in the past, we've seen regulation by reflex. Rather than preempting crises, regulators have frequently reacted to them after the fact. They played the role of a hazmat cleanup team instead of preventing dangerous spillovers in the first place. Regulation by reflex has led to a regulatory myopia that has undermined safety and soundness. Under President Biden, the bank regulators preoccupied themselves with reputation risk, climate-related financial risk, and other risks with no clear nexus to safety and soundness. At the same time, they centered supervision on management and other governance matters that distracted examiners and banks' risk managers from the real risk to safety and soundness. The result, predictably, was the second, third, and fourth largest bank failures in U.S. history in 2023. Besides undermining safety and soundness, regulation by reflex has driven excessive regulation. That can lead to economic stagnation, and economic stagnation is itself a grave threat to financial stability. In calibrating regulations, federal agencies must avoid the temptation to create a zero-risk financial system, which would result in what others have called the stability of the graveyard. FSOC should aim to identify vulnerabilities that could lead to systemic crises and encourage the private sector to mitigate those risks before recommending additional regulation. FSOC should also work with its members to support efforts to avoid or pare back existing regulation that stifles pro-growth lending, capital formation, and innovation. And the best way to achieve these goals is by centering economic growth and economic security at the heart of FSOC's agenda. Promoting economic growth and economic security is essential to ensuring financial stability. Economic growth strengthens household, business, and financial institution balance sheets, creating capital buffers that reduce the risk of defaults and financial stress. And economic security reinforces domestic production capacity, raising living standards while reducing vulnerability to external shocks and supply chain disruptions. FSOC's annual report prioritizes economic growth and economic security accordingly, with a specific focus on 4 policy areas: Treasury markets, cybersecurity, regulatory modernization, and AI. First, the Council is ensuring that the U.S. Treasury market remains the deepest and most liquid in the world. The Council is supporting efforts by member agencies to strengthen this market against future shocks, including through the Interagency Working Group on Treasury Market Surveillance and the Market Resilience Working Group. Ongoing monitoring and targeted reforms by individual agencies remain essential to financial stability. Second, the Council is taking action to protect our financial system from increasingly sophisticated cyber attacks. Nation-state actors and criminal groups continue to target our financial institutions and infrastructure. To address this risk, the Council is supporting expanded information sharing, joint monitoring, and scenario-based exercises, and it is emphasizing the need for regulated firms to manage cyber risks tied to third-party service providers. Third, the Council is committed to supporting efforts to modernize supervisory and regulatory frameworks for banks and credit unions. Going forward, regulation and supervision should address material risk, enhance transparency, and reduce unnecessary burdens, particularly for small and community banks. Fourth, the Council is prioritizing the responsible use of artificial intelligence to strengthen financial stability. The Council is working with public and private partners, including international counterparts, to enhance system resilience while closely monitoring emerging risks. I will close by highlighting our progress in enhancing the utility of our annual report. In this year's report, FSOC shifted away from its past approach, where nearly every major market and financial sector was described as a financial stability vulnerability, by introducing a new structure centered on fostering economic growth and security. We're tuning out the noise to concentrate on the issues that matter most for U.S. financial stability. With this overview, I look forward to taking your questions.
We'll now thank the Secretary, and we will turn to member questions, and I recognize myself for 5 minutes for questions. You made a persuasive case that since President Trump was sworn in, that economic growth is a cornerstone of his presidency, and you highlighted today, as you have in speeches over the year, the importance of that Wall Street's doing well, but it's Main Street's turn, and you'd like to see economic growth expanded into what I always quote from Steve Case, the rise of the rest, where we see that economic performance expand across the country. We share that commitment here on this committee about reversing elements of the regulatory framework that have sought, possibly certainly well-intentioned, the concept of too big to fail, but ended up in creating an environment over the past 15 years where community banks are too small to succeed, or maybe avoiding your term today you chose to use, the stability of the graveyard. The committee has worked together on a bipartisan basis to highlight some of the principal actions that we've considered over the past year. Our Main Street Capital Access Act, which we intend to bring to the House floor. We're grateful for your Undersecretary, Mr. McKernan, who last month joined us as we rolled out that package to talk about how we can collaborate. Would you take a minute and from your perspective, how do strong, well-capitalized community banks and the benefits of tailoring that are in this legislative proposal help accomplish faster economic growth and the rise of the rest?
Chairman Hill, as I've said, it's Main Street's turn, and essential for Main Street's having its turn are the small and community banks. And I would note that thanks to onerous regulation, and as you and I both say, community and small banks became too small to succeed. Tragically, more than 50% of our community banks have disappeared since the great financial crisis, not during, since. There have been virtually no de novo banks created, whereas before the GFC, there were more than 50 per year. And small and community banks not only are the anchor for community-based lending, but they provide the bulk of the lending for agriculture, for small real estate loans, and for small business loans. So a thriving community bank infrastructure and ecosystem is essential. I've met with more individually and in roundtables with more than 200 community bankers. I've spoken at conferences with more than 1,000, and tailoring is essential. I had one banker from my home state in South Carolina with assets of about $200 million tell me that under the previous regulatory regime, she was told that she should be more like Bank America, the second largest bank in the country. And so it is essential that we have the right tailoring, right risk levels, and right monitoring of these important institutions.
We thank you for your perspective on that, and to illustrate it in our work we've done on housing in the committee, also on a bipartisan basis, it was noted that banks under $10 billion in size, really the heart of our community banking system, several thousand banks across the country, they make 60% of our 1 to 4 family construction loans. And while banks of all sizes deliver amazing capital access in our economy, at the heart of our Main Streets, if we want more housing supply, we find that it's really that local grassroots, public or privately held community bank that helps lead that. You mentioned de novos, and under Chairman Barr's leadership in our subcommittee, and on, again, with bipartisan support, we've enhanced in the Main Street Capital Access Act ways we think that will speed up and make easier to get both deposit insurance, raise capital, and tell the story about having more dynamic de novo bank formations that, as you say, have been so slowed by the last 15 years. Turning to digital assets, something that we've talked about quite a bit in the time remaining, can you tell me your assessment of how the regulatory process is coming for the implementation of the Genius Act?
The Genius Act was an important act, important piece of legislation for bringing back into the U.S. the regulation, creation of digital assets, and making the United States a national champion. The Genius Act and the stable coins that will be created with that could in fact be an important feature of financing the U.S. government. And we are moving with deliberate speed to round out the House and the Senate's intention on that important,
Thank you very much, Mr. Secretary.
piece of legislation.
Appreciate your work and leadership there. I now recognize the ranking member of our committee, Mrs. Waters of California, for 5 minutes for questions.
Thank you very much, Secretary Bessent. In the FSOC annual report, you stressed the importance of economic growth to promote financial stability. While you noted many ways you plan to deregulate Wall Street and plant the seeds for another crisis, you said little about the harms of inflation. I find this odd, as the president and you have finally began discussing in the media how the price of goods are way too high. Notably, you mentioned that tariffs may need to come down to lower costs for Americans. So I have a few questions about this. As a former hedge fund manager in 2004, and I don't want you to go into any long details about this, but did you write a letter to investors raising concerns about the impact of tariffs, writing that, quote, tariffs are inflationary? Did you say that at that time, yes or no?
No.
Okay, thank you. Okay, we have a New York Times article that, agrees that you said
New York
that.
Times.
Then last summer, when you testified before a Senate committee, you said, and I quote, "There is no inflation. Tariffs are not being passed on to consumers." You were quite definitive and even claimed that critics had, quote, "tariff derangement syndrome." Well, those comments are at odds with the statement you made to investors that tariffs are inflationary. Again, I want to be clear, so just let me ask you, are tariffs inflationary, yes or no?
According to the San Francisco Federal Reserve, with 150 years of data,
Yes or no?
Tariffs do not cause inflation. San Francisco Federal
Well,
Reserve.
last November, as the
Congresswoman,
Trump administration finally began to realize
150 years
that
of data.
affordability issues in America are not a hoax, you told Fox News that the government was going to reduce tariffs on goods like coffee and bananas, and that doing so would, quote, bring the prices down very quickly. Mr. Secretary, why was that announcement even necessary? If tariffs aren't inflationary, and as you and the president like to say, are paid for by the foreign country, a tariff on coffee or bananas shouldn't raise the price of either for American consumers. Well, that's the Trump logic, but that isn't reality. It did raise prices across the board, and you know it. I think you knew back in July also. The real question is, why would you even impose a tariff on a good that a country doesn't grow or make, as that would only serve to punish the American consumer? Now, as you know, this committee has taken a bipartisan approach to addressing another real affordability crisis. Housing. Rents are too high. There aren't enough houses. However, one clear reason that the housing crisis has grown worse is that you and the rest of the Trump administration levied tariffs on housing production goods like lumber and steel, as well as appliances. These tariffs will result in half.
Lumber is
reclaiming my time. You don't get to talk.
Lumber is at a 5-year low, Congresswoman.
Reclaiming my time.
Let's just have the facts, ma'am.
Reclaiming my time. Thank you. However, one clear reason that the housing crisis has gone worse is that you and the rest of the Trump administration levied tariffs on housing production goods like lumber and steel, as I said, as well as appliances. These tariffs will result in 500,000 fewer homes built at a time when we need more homes built, not less. Trump single-handedly made housing more expensive. And once again, you know it, as Axios has reported that you were planning to lift tariffs on housing production goods. In addition, the unlawful campaign the Trump administration has waged with ICE and Border Patrol terrorizing American communities has also harmed home construction across America. So I ask you, Secretary Bessent, will you be the voice of reason in the administration and urge Trump to stop waging a war on American consumers and on housing or affordability and putting the economy at risk? Yes or no? You don't have to explain.
Representative
Will you be the voice?
Will you be the
voice? Will you be the voice?
Of inflation?
Will you be the voice of reason?
And
will you be the voice of reason?
A study
yes or
from
no?
Wharton University
Reclaiming my
has
time.
shown
Reclaiming my time.
the biggest reason for
Reclaiming
housing
my
increase
time.
was the mass
Reclaiming my
unfettered
time.
immigration.
Mr. Chair, will
you
you
let
let
in
him
between
know
10
that
and
when I
20
ask
million
him
immigrants.
Time does
took
belong
up
to
the
the
housing
gentlewoman
stock.
from California.
10 and 20 million immigrants
Can you
took
shut
up the
him up?
housing stock of working Americans, and can you maintain some level of dignity?
Gentleman's time has expired.
No, my time has not
Your
expired.
time has expired. And the
The
gentleman,
gentleman took up my time. I think you should recognize that, Mr. Chair.
the gentlewoman's
He took
time
up
has
my time.
expired. The gentlewoman's time has
Well,
expired.
if you
Mr.
wanna
Chair,
put-
parliamentary
If you
inquiry.
wanna
Chair,
protect him,
the chair
Mr.
recognizes the vice chairman of the
Mr.
committee,
Chair.
Mr.
If
If you
Heisinger.
want to
Parliamentary inquiry.
go right ahead, but I would not expect you to do that.
Thank you, Mr. Chairman. And I will grant very briefly any time that you feel like you need to address anything.
Again, I think the ranking member does not understand.
Mr. Secretary, I'm sorry, the gentleman will suspend. There's a parliamentary inquiry. Mr. Sherman?
Mr. Chair, will you enforce the rules of this committee so that the time belongs to the questioner and prevent filibusters from taking time away? And if those filibusters by the witness do take time away, will you allocate additional time?
I will enforce the 5-minute rule. The
I
gentleman
want my
from-
time back.
The gentleman from Michigan is recognized.
I grant briefly anything that you feel you need to address.
I believe the ranking member does not understand the definition of generalized inflation versus one-time price increases. I would also note that housing, especially for working Americans, a Wharton study has shown that the mass unfettered immigration, adding 10 to 20 million new people demanding housing, Congresswoman, is what caused a great deal of housing inflation for working Americans. So you and the Biden administration should be ashamed.
Which is also why we are seeing rents. There was just a recent media story on this. Rents are going down partially because of that enforcement. So Mr. Secretary.
Yes, it is supply and demand continues to work.
I've got a number of issues I got to hit very briefly here on FSOC. I need to talk then Burma and 3%. You talked about with the chairman about regulators using tailored market approach tools. How are you ensuring that FSOC's current work continues to prioritize activity-based, transparent, analytically rigorous approach grounded in cost-benefit analysis and coordination with functional regulators when evaluating potential risks in non-bank financial markets?
That is done primarily for small banks through the Office of the Controller of the Currency and the FDIC. And those chairs are intent on tailoring the rules for small banks so that we do not have another 50% decrease in Main Street lending.
All right, thank you. You outlined as part of the 4 goals, protecting, number 2 was protecting from cyber attacks. We have seen a rise in those cyber attacks and scam centers in Burma. And I applaud you and Treasury for some of your work in that, including sanctioning North Korean individuals, selling weapons to the Burmese military regime, as well as the Democratic Korean Benevolent Army, a Burmese army group that has organized these scam centers. However, last week it was reported that Iran was secretly shipping vast amounts of jet fuel in Burma. And I need to move through this quickly here, but that's why last year I introduced a bipartisan legislation that would specifically require the president to determine whether to impose stronger blocking sanctions on Myanmar Oil and Gas, Myanmar Economic Bank, and foreign persons operating in the jet fuel sector of the Burmese economy. I read recently that Treasury responded to Reuters' report by noting that Iran's quest for, quote, new markets is a sign that President Trump's policies are working, which I would agree. I'm also aware that Burma's military leaders have attempted to gain favor with the president, especially when it comes to lowering tariffs levied on his country. This is something that simply cannot happen. I represent a significant Rohingya population and know that the active bombing that is going on is unacceptable. And I believe we must continue to impose strict sanctions on the Burmese military rulers. What tools can Treasury use to punish both Iran and Burma for violating both U.S. and other Western country sanctions?
Well, with respect to Iran, President Trump, upon entering office, instructed U.S. Treasury to implement a maximum pressure campaign, and we saw the fruits of that campaign in December as the Iranian economy has collapsed. Yeah. We had a large bank collapse there. The central bank was forced to bail it out, created inflation, and the brave Iranian people have taken to the streets. We continuously monitor trade between two countries like that. The good news would be Iran has a significant shortage of dollars to buy, whether it is weapons or goods for the people, or to pad the Swiss bank accounts of the Iranian regime.
We've got to keep the pressure up on Iran, but also that pressure on the Burmese junta, please. Lastly, I'd be remiss if I did not thank you in public for your discussion of a desire to lower the deficits to 3% of the GDP. I've introduced, along with 14 of my colleagues from the Bipartisan Fiscal Forum that I chair with Congressman Scott Peters out of California, that urges the House to achieve this 3% goal by 2030, a tangible, achievable goal that is desperately needed, and we're building consensus here in the House. I know you and the administration take the ticking debt bomb seriously, and I hope that to continue this conversation with you. I don't know if you can, in 10 seconds, address.
I look forward to working with you on that, and I would note that the deficit to GDP, calendar year 2024, 7%, highest, not at war, not in recession. Calendar 2025, down to 5.4%.
Gentleman's
I
time
yield
has
back.
expired.
Thank you.
Chair recognizes the gentleman from California, our ranking member of our Capital Markets Subcommittee. Mr. Sherman, you're recognized for 5 minutes.
I want to agree with the gentleman from Michigan that we need to impose those sanctions on the Myanmar regime and protect, of course, the Rohingya minority to the extent we can. FSOC has to define what is systemic. I, for one, think that we shouldn't be focusing on the assets, but rather the liabilities. We didn't have a problem in 2008 because the banks had too many assets. We had a problem because they had too many liabilities. So I don't see how most—
Congressman, that's incorrect. Ben Bernanke, then Fed chair, said, could you please tell me what these assets are?
I'm going to reclaim my time. Regardless of that, I'm going to ask you whether you— not going to ask you to agree with me. I'm going to ask you to agree with your predecessor, Secretary Mnuchin. During the first Trump administration, that Secretary Mnuchin promulgated interpretive guidance that prioritized an activities-based approach to systemic risk regulation over an entity approach. Secretary Bessent, you have indicated that you want to kick off a review of FSOC's activities and processes. The FSOC Improvement Act, led by my colleague, Dr. Foster, which I've co-sponsored, as you know, would codify an activities-based approach to systemic risk regulation. Does the FSOC plan to revert to the 2019 guidance of the first Trump administration regarding a definition of a SIFI?
Yes, we prefer an activities-based approach rather than an institutional-based approach.
Thank you. I want to pick up on the ranking member's comments about whether tariffs cause inflation. You know, economists can say when the price of something goes up by 20%, that isn't inflation. It's a one-time price increase. But out in my district, when the price of something goes up by 20%, we call that unaffordability. And to say it's not inflation is sophistry. I'll point out that every time Democrats had regulations that increased a company's cost, People in this room said that's going to cause inflation. Well, tariffs clearly have to be paid by companies, and if environmental costs are passed through, you can be sure tariffs are passed through. The ranking member asked the question, why a tariff on coffee and bananas? I think the answer is obvious: to make our tax system more regressive, to pay for the big, bad, beautiful bills, cuts in taxes for billionaires, and to fund ICE. I used to head this largest sales tax agency in this country, and we knew the sales tax was regressive, but we knew it would be even more regressive if we imposed sales taxes on food. And that is what you do with a tariff on bananas and coffee. Mr. Secretary, we lived through the bailouts of 2008 when powerful men lose money. They now want a government bailout. Does the Treasury Department or the various components of the FMOC have the authority to bail out Bitcoin?
Could you please elaborate? What exactly does bail out Bitcoin
Okay,
mean,
could you
Congressman? That's a
instruct the
very-
banks of this country to buy Bitcoin, or change banking regulations so that they are encouraged to do so in terms of the reserves that they're otherwise required to have?
Again, that within the context of asset diversification within banks, they could hold many assets.
They can, and they're different, but do you have the authority to order banks to buy Bitcoin or to invest U.S. tax dollars in Bitcoin or Trump coin?
I am Secretary of the Treasury. I do not have the authority to do that, and as Chair of FSOC, I do not have that authority.
So we're not going to see our tax dollars invested in crypto assets?
Well, why would a private bank be your tax dollars, Congressman?
Excuse me, I'm now asking about the money of our taxpayers, which you manage as Secretary of the Treasury. Is it going to be deployed into crypto assets?
We are retaining seized Bitcoin.
That's not exactly taxpayer money. You collect a lot of taxes this month?
No, that is an asset of the U.S.
It's an asset of the
It is an
U.S.
asset of the
It
U.S.
was
government.
Are you going to invest any?
And I will point out,
Mr. Secretary, reclaiming my time, are you going to invest?
from
the
California,
asset
stop.
seizure, that 1 billion of Bitcoin was seized, 500 million was retained, and that 500 million has become over 15 billion.
Gentleman's time has expired. The gentleman from Oklahoma, the chair of our Monetary Policy Task Force, Mr. Lucas, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Secretary, for being here today. You've said that the current deposit insurance framework is a vulnerability for the banking system, that there is a competitive imbalance that favors large banks, and that this increases the risk of bank runs and erodes depositor confidence. Can you talk more about a targeted expansion of deposit insurance for non-interest-bearing transaction accounts, and would that strengthen financial stability within the system?
Congressman, thank you for that very important question, because it is my belief, because there is the belief that big banks, the depositors, will not lose money. During a financial crisis, as we saw in 2023, assets leave small banks. And much of that is what is known as the payroll account. So I think it is very important for small banks to have one non-interest-bearing account that can have a much higher level of insurance so that they are able to retain deposits during a stress period. This is one of the reasons that we have seen assets leave small banks. It is one of the reasons that we have seen 50% of small banks disappear.
Continuing along this line of inquiry, Mr. Secretary, a robust banking system with healthy banks of all sizes reduces systematic risk across the entire system. Why is it important that Congress act now on targeted deposit insurance reform, not only for Main Street, but also our financial stability?
Well, again, deposit volatility, which is what you're referring to, is deposits moving during a stress time, does not benefit anyone in the long run.
And one more question on this perspective. Congress should look at giving FDIC authority to raise the coverage level for non-interest-bearing transaction accounts to an appropriate amount that is data-driven and put smaller institutions on a level playing field with larger banks. How would our banking system be safer with a narrow, targeted expansion, such as the one I've suggested?
Again, it would permit the small and community banks to continue competing. It would get credit to our Main Street, and it would stem deposit flight during a period of stress, which is one of the most, or one of the biggest threats to financial stability.
Focusing on a slightly different subject. Sometimes something I've focused on as chairman of the Task Force on Treasury Monetary Resilience has been strengthening market stability and liquidity. We saw occasional bouts of Treasury market volatility last year. How would reforms to banking regulations like the liquidity coverage ratio and stress tests incentivize market intermediation for banks and improve market stability?
Again, Congressman, wonderful question, that it brings more of our Treasury market onshore. And as you said, there were periods of stress last year. The market successfully navigated those. At the end of January, we had the third highest volume in the Treasury market, and the bid-ask spreads, very important for the financial well-being of the American people who are invested in money market funds, in bond funds, in their retirement funds. They have stayed right in the center line, and we are at a 5-year low in bond market volatility.
Thank you, Mr. Secretary. I yield back, Mr. Chairman. Thank you.
Gentleman yields back. Chair recognizes the gentleman from New York, ranking member of our Foreign Affairs Committee. Mr. Meeks, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Secretary Bessent, if I'm not mistaken, you were working in the financial service industry during the late 1980s, correct?
I was.
Thank you. And well, I'm wondering, do you recall or you're knowledgeable of the Keating 5 scandal back then?
Yes, sir, and I will point out that I was.
I don't want to.
No. I will point out that I identified.
The gentleman is from the Secretary. Is the gentleman from New York Times?
So I just want to make sure that everyone knows, who doesn't know, that the Keating 5 scandal involved 5 U.S. senators accused of pressuring the Federal Home Loan Bank Board to expedite and give more consideration to the case of Charles Keating Jr., who ran the California-based Lincoln Savings and Loans. It led to a 14-month investigation unveiling how 5 U.S. senators and staff ended up with more than $1 million in contributions, 4 trips to the Bahamas, and all expenses paid stays at resort hotels. Following the scandal, the industry saw sweeping regulatory changes that was launched by then-President George H.W. Bush. Now, Mr. Secretary, I'm sure you can agree conflicts of interest and improper influence by U.S. elected officials over bank regulators weaken supervisory independence and ultimately impose massive losses on consumers and taxpayers. I think that we can all agree upon that. And as we know, the basic lessons from the post-Keating reforms still applies today when the Office of the Comptroller of Currency, the OCC, is deciding to get a bank charter. I think we can stimulate that. Now, Mr. Bessent, as our nation's treasurer, I'm sure you also know that a foreign-linked investment firm tied to the United Arab Emirates government quietly bought about half of the Trump family's crypto company, World Liberty Financial. And at the very same time, the President of the United States was dealing with that country on foreign policy. Now, Eric Trump, the president's son and co-founder of World Liberty Financial, said, and I quote, "I'm not going to get into who the investors are, but I've got some pretty meaningful investors," end of quote. Lack of transparency. And it didn't end there. When Trump fans brought the tokens, they thought they were getting the deal of a century. But what they didn't know was that only Trump and his sons had the sole power to decide who can sell the token and when. Today, the price of the token has fallen over 50%, and the Trump fans who bought the token are now begging to get out. Now, I'm not making this up. I'm not making this up. You can see it for yourself on the World Liberty Financial Discussion Forum Yeah, yourself, Mr. Secretary. So this is no longer just about a shady crypto deal or a possible gift when a foreign linked investor is putting hundreds of millions of dollars into a company controlled by the president's family, and at the same time, this president is conducting foreign policy with that country. You know what that creates? It creates a national security concern. So, I'm not going to ask much of you, Mr. Secretary. I just want to know whether you will commit today to pause and heighten the scrutiny of any bank charter or licensing application at the OCC connected to the World Liberty Financial until all of these conflicts of interest and foreign influence reviews are completed and shared with the United States Congress. All I need to know is, will you halt it and do a complete investigation and scrutiny of this licensing application? All you have to ask is yes or no.
No, Congressman.
All you have to ask
the
is yes or no.
OCC is an independent entity, and I would know, Congressman.
So I take that as a no.
You traveled to Venezuela.
I take that as a no.
On behalf of
I
your
take that
donors,
as a
on
no.
behalf of your
You
donors,
do not want to answer that
I was
question.
sentenced to 110
I take
years
that
in
as a
jail
no.
For a $7 billion
Gentlemen's
contract.
time
I'm asking you to do your responsibility as Secretary of the Treasury.
Into a Venezuelan.
You do not.
Mr. Meeks,
Will you?
time has expired.
You cannot erase what you did in
He's the one that went
2006.
past your time, Mr. Chairman.
No, and
He did not answer my question, and he wouldn't pass the
Mr.
time.
Meeks. He had 6 seconds left to try to answer your question, and the
It was
time
a yes or
expired.
no. It was a yes or no answer. I asked him, will he? No, was that
Gentlemen,
yes
the
or
chair
no?
recognizes
OCC
the
is an
gentleman.
independent
Stop
agency.
Mr.
covering
Bessent.
for the president.
Yeah, well,
Stop being his flunky.
and
Gentlemen.
He's talking to me. I'm responding
your
back to him.
2006 trip to Venezuela.
Neither one.
Stop
why don't you
covering
tell
for
the
the
Secretary
president. Don't be a
that?
flunky. Work for the American